Conrad, good to see you. So three quarters of a challenging year for our industry are over, but let's maybe start looking at the third quarter. How have we been doing?
Yes, good morning, Kai. Overall, we have delivered a very resilient result. I thought it was very good to see growth back in our A&A business, our additives and adsorbents business, with an overall 7% top-line growth in local currency. I thought it was also very good to see growth in our chemical business, with an overall growth of 5% in local currency, very much also helped by the recent addition of Lucas Meyer, which contributed about 4% to that growth. Where we still see headwinds is in our catalyst business. Now, we have to remind ourselves this runs on a late cycle. So we're now seeing the effects in our catalyst business of the low operating rates that we had in chemicals in our industry a year ago. So this still is a challenging environment where we had overall growth of minus 20%. And the net result of these three businesses together was a minus 1% local currency headline growth number.
Yeah, maybe coming back to what you said about additives. So growth is back. We've been struggling here for some time. So what are the reasons behind this pickup in growth?
Yeah, what you see in additives is that we have a rebound now from the weak demand that you saw post-COVID. If you look at the numbers right now, for the first year, you see actually electronics sales up. So you see cell phones up around 5% year on year. Laptops, computers, a little bit less, but still in positive territory again. And that wasn't the case in the first years after COVID. Remember, in COVID, most of us replaced cell phones, replaced computers. We were putting up home offices. That demand is actually back. And then also electric vehicles demand keeps going strong. It's slower growth than last year, but we still see around a 20% growth in electric vehicles globally. So it's really a demand-driven recovery in our additives business that we're enjoying.
And we are obviously able to serve our customers through our new build capacities in China then.
Now, this is a very important point you mentioned. Our new flame retardant plant in Daya Bay, a local plant in China, is very well positioned to supply this local demand. And in China, in fact, we have double-digit growth for our additive business year on year.
And maybe coming back to Care Chemicals, so you mentioned we had a 5% growth. How important is Lucas Meyer in this area?
Yeah, Lucas Meyer is important. If you look year on year, 5% growth in Care Chemicals. If you take Lucas Meyer out, 1% growth. What is interesting to see is that Lucas Meyer is delivering the high growth expectations that we had for that business. There is a slowdown in luxury goods. We've all seen the announcements by companies like LVMH, Kering, L'Oreal. They see slower sales. If we look at Lucas Meyer, the company is delivering the solid 10% growth expectation that we had. And what you see is the growth is less coming from these strong global luxury brands, but it is very much coming from these indie brands, which keep growing double-digit rates.
So overall, a mixed picture with regard to top line. Now, how does that translate into our margins?
Yeah, if you look, what does this all add up to in terms of profitability? What you see is we had a solid 15.6% EBITDA margin. That is actually a bit slower than the 15.9% last year, but it's also on a lower revenue base. So overall, I think we've managed margins well. We've also managed our costs very well. If you look at the cost out program of 175 million Swiss francs, we've actually delivered 162 million Swiss franc savings versus that program already.
Yeah, very good. So it's an ongoing difficult environment. So maybe let's talk about current trading conditions a little bit. How do you assess overall the market situation?
Yeah, the market situation is very different by region. It's very different by segment. So what you see overall is that we are delivering right now strong growth in A&A, in our adsorbents and additive business. We expect this momentum to continue into the fourth quarter. What you see is that we have a resilient growth in Care Chemicals, especially in the consumer markets. We see continued solid growth in Care Chemicals. Where we struggle is in Catalysts, but we are expecting a sequential improvement into the fourth quarter. Traditionally, there is a seasonality in this business where there are more shutdowns of customers, maintenance shutdowns in the last quarter of the year. We do see typically a pickup in Catalyst in the fourth quarter, and we expect that this year as well, in line with the prior year's seasonality.
Mm. And if we ask the question, and that is an important one, have we reached the bottom now looking at the overall economy? Do you see us here already reaching the lower end, or do you expect this to continue?
No, I think as an industry, I think we have reached bottom in the second and in the third quarter. So if you look basically at the numbers, overall a robust GDP growth this year, roughly 2.7%. If you look at the latest Oxford Economics number for this year, expectation for that to continue into next year, even possibly slightly better. What for us is important is this shift back to durable goods and semi-durable goods, and that shift has started this year already. We do expect that to continue into next year.
Very good. So I see you being optimistic in that sense. So what does that mean for our outlook starting with 2024? So we have guided for around a 16% EBITDA margin, and we just reduced our sales guidance slightly. So are you still confident to achieve the margin target?
Yeah, if you look at the outlook for this year, what we have communicated this morning is for revenue to be slightly down in local currency from prior year. That is very much driven by Catalyst, with the other businesses actually all slightly up from prior year. So there is growth back into the other businesses. If you then look at profitability, on a slightly lower revenue base, we expect to still continue to finish the year around 16% EBITDA margin in reported numbers. So that is obviously margin management that we continue to do well. And it is the delivery of the cost improvement programs that are coming through in the numbers.
So we will see in 3 months from now. Maybe to conclude, Conrad, last Friday, Clariant has announced that the board of directors has nominated a new chairman to be elected at the AGM. Ben van Beurden, he is a Dutch citizen, just like you. So do you know Ben in person? I know you both worked at Shell. And what is your general opinion about this nomination?
Yeah, I actually did my master thesis at Shell. It was sponsored by Shell in the early 90s when I was a young engineer. So probably the best way to put it is I knew of Ben because he was already high up in the organization at Shell Chemicals in those days, but I'm sure that he didn't know of me because I was a student working hard to finish my thesis. But I do welcome Ben coming to our company. He obviously has a very impressive track record as the prior CEO of Shell. I also very much appreciate his commitment to sustainability. It was Ben who actually made sure that Shell was the earliest oil and gas company that came out with climate targets. And this is something that is important to us. This is a priority for us as well, and we will continue that as a priority.
Yeah, thanks a lot, Conrad, for these personal comments also. And I wish you the best for the final quarter of this year, and then we will talk again in 3 months from now.
Thank you, Kai.